I know there's a lot of noise about recession, recession, recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction. And that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now.
A global stock market rout was triggered by U.S. recession fears on Friday, leading to significant losses across major indices. Japan's Nikkei saw a 12% drop on Monday, marking its worst day since the 1987 Black Monday crash. South Korea's Kospi index fell by 9%, while the Nasdaq plummeted 6% just seconds after the opening bell in New York. The crash quickly rippled through the markets, with leading cryptocurrencies like Bitcoin and Ethereum experiencing their steepest single-day declines since the FTX collapse in 2022 and 2021, respectively. The VIX, a gauge of stock market volatility, surged nearly 90% within days, approaching multi-year highs. Although the market saw a slight rebound on Tuesday, uncertainty still looms as investors wonder whether Monday's wild swings mark the end of the global sell-off that began last week, or the start of a broader crash with far-reaching consequences. Despite the turmoil, popular macro analyst and former Goldman Sachs executive Raoul views the situation as business as usual. Powell suggests that the sell-off could ultimately benefit the crypto market by pressuring central banks, including the U.S. Federal Reserve, to cut rates and halt other quantitative tightening measures. In a recent tweet reacting to the crash, Powell noted, "I've been writing and talking for a while about the Chinese needing the dollar and yen lower so they could ease policy without sacrificing the RMB. Yellen has been over in China twice to discuss this. U.S. rates need to come lower too, to help, and that is now underway." The Japanese revaluation of the yen was part of a larger agreed-upon picture among central banks to inject liquidity into the system and revive global growth momentum. A weaker dollar is what everyone needs to add liquidity and loosen financial conditions. It will mop up this current mess caused by that regime change. King dollar no longer stands in the way. Powell delves deeper into this macroeconomic perspective in a recent video, where he explains how the crash aligns with his broader predictions for the U.S. and global economy, particularly concerning cryptocurrency prices. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
You see, what's been happening is we have needed stimulus into the global economy because the economy has been slow. The ISM survey has been bumping along the bottom. China's slow. Europe's slow. And you see, one of the component parts that allows for this all to move hadn't really been playing ball. Firstly, it was US rates, but the Fed gave us that signal. So that started moving. But the big one is King dollar. The dollar has been strong, and a strong dollar is a tighter financial conditions, which doesn't help markets and doesn't help economies. You see, at this point in the cycle, when there's no inflation or inflation is falling fast, generally you need a weaker dollar. That brings global growth. So if you remember, Janet Yellen went to China twice earlier in the year. Those conversations, I believe, were about how we can allow China to stimulate without sacrificing the yuan. You see, if China had stimulated with the dollar strong, the yuan would have collapsed, and they can't deal with that. They really want to keep their currency stable. So they will have said to the US, we get it, we need to stimulate. We've got a debt deflation going on, but we can't stimulate. You need to help us. And Yellen would have said, of course, what can I do? And the answer is, well, obviously, you need to cut rates. And that's like, yes, we understand that. That's on the cards. But then it's like, you must weaken the dollar. So cut to the Bank of Japan. The Bank of Japan is the big player in all of this. And the Bank of Japan had been suffering from a weaker and weaker yen and the stronger and stronger dollar, and had started to make noises that it wanted to do something about it. So the Japanese banking market is the eurodollar market. It's the global lending of dollars, really comes out of Japan. And Japan didn't really have enough dollars. So what they had to do, the world doesn't have enough dollars. So Yellen will have spoken to the Japanese, as will have Powell. And the idea is listen, you intervene in the currency, that's injecting of liquidity. Help us start lowering the dollar. You can be the big driver here because this is how you operate your currency system. We will reciprocate by cutting rates. And the Chinese will be able to stimulate their economy without losing control of their currency. That's something I wrote about for a while, and I've talked about that this was the big plan. So we started to see yen intervention. Now, the thing about the yen, as the Japanese also raise rates, the thing about the yen is that a lot of people borrow in the currency because it's cheap, and then they invest in other assets. It's called a funding trade. And that's all well and good, and it can deal with normal volatility. But once the Japanese started to intervene in the currency, it starts knocking people out of their positions. Those positions become less profitable. So what happens is they are forced to reduce risk. In banks, it's called VAR and hedge fund, which is value at risk. So if the currency moves a lot, their funding currency, or in fact, any major currencies, what they have a tendency to do is start having to liquidate other positions. That started knocking into the NASDAQ, riskier assets, as people start reducing the higher volatility positions, and it knocks all the way through the chain of all assets. That's why you get this correlation of one event when everything moves together when they weren't correlated before. It's because everybody's forced to puke risk at the same time. So the risk puking had started and then really started to gather steam. Now, for all of us, this is like, what the are you doing? You're nuking my bags. I get it. But again, there's a bigger game to be played. The bigger game is they want liquidity into the system. And to do it, you're going to have a regime change. And that creates a macro spasm. Now, these macro spasms are not uncommon. You tend to get one every business cycle, particularly around regime changes. So, we saw one in 2018. That was at the end of the hiking regime. We saw then this spasm as the market essentially forced the Fed to pivot, the Powell pivot moment.
According to Raoul, these macroeconomic spasms frequently occur during periods of financial stress. While they tend to be short-lived, often lasting just a few weeks, they deliver a significant impact and typically conclude with central banks stepping in to provide more liquidity to stabilize the markets. For Powell, this timing couldn't be better for central banks, as it conveniently addresses the challenge of refinancing the world's massive debts at high interest rates. Central banks, including the Federal Reserve, now have a valid reason to cut rates aggressively without triggering widespread panic. Powell succinctly summarizes the situation in another post on X, stating, "Well, that's going to solve the issue of global central banks having to refinance their debts at high rates. My guess is that rates over time come down to 2.5%. Next up, they'll need large amounts of liquidity to monetize the previous cycle's interest payments and roll them over. That will come in due course, more cowbell. We might even see war added to the list of reasons to inject liquidity, but that brings more uncertainty, fear, and volatility. Instead of panicking over price movements, recessions, or the global economy, Powell advises focusing on whether the underlying business cycle has fundamentally changed. He emphasizes that we are still at the bottom of the business cycle, with a massive easing of financial conditions already in place, accelerated by the decline in the dollar and interest rates. Additionally, several forward-looking indicators are showing signs of a strong recovery ahead. Powell discusses these indicators further in his latest video, offering deeper insights into the potential trajectory of the market.
Now, the business cycle, remember I said, well, the business cycle is bottoming and not peaking. I know there's a lot of noise about recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction. And that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now. It's kind of noise because most of the markets I concentrate on, crypto and technology, are priced off liquidity conditions and financial conditions. But we are at the relatively slow point of the economy where rate cuts are now kind of preordained, and the things that back it up are things like unemployment. I've been talking for a while that unemployment should rise. I don't think it's going to go super crazy, but now we're at the point where we're beyond the unemployment rate of the most negative Fed member. So obviously the signal is there to cut rates, and the Fed have made that clear. Maybe they come sooner, maybe they don't, maybe they inject liquidity in different ways. But either way, unemployment has been rising, and that is a key factor for the Fed, and inflation has been falling, which is the key factor for the Fed. So it's green lights all round to cut rates, and cut rates allows liquidity to come in to the system. So what happened is this mix of the DXY, which is the dollar, and the 10-year bond yields, and Fed rate cuts all came from the Fed starting to suddenly say, well, the market's starting to realize the Fed were going to change course, and then the Fed changing course by saying they were probably going to cut at the next meeting. And that set this whole thing off. Now, there's a lot of rate cuts priced in. They weren't priced in before, but I think they're more correct in how they're pricing things in. Will it work exactly how the markets are suggesting? I don't know. But I think rates come down to 2.5% or lower in this cycle. If you remember, the everything code needs low rates because you have to refi the $10 trillion of debt. So you need low rates to do that and liquidity to pay the interest payments on the prior cycle's debt, which is why the everything code is so important in this and why we keep repeating the same old cycle. It's because it's about paying the refinancing costs of the debt. And we're deep into the refi cycle. So I've been explaining for a while, the Fed and all the central banks need low rates. The Treasury needs liquidity within which to roll that and also to monetize the previous interest payments. That monetization of interest payments is what drives the liquidity cycle and the debasement cycle, which drives up assets. Also, as the business cycle bottoms, people have more money, businesses have more money, gets reinvested, people invest more, and that builds on a cycle. Things like emerging markets do well when the dollar weakens. So therefore, profits get reinvested in the system, and the virtuous cycle of macro summer and macro fall play out. And that should play out all the way into the end of 2025.
Crypto asset prices have seen a sharp decline over the past week, with Bitcoin dropping by more than 16% and Ethereum by over 27%, making it the hardest hit among the top 10 cryptocurrencies. Despite this, Raoul remains highly bullish on crypto assets for 2024 and beyond. He humorously describes the recent market turmoil by saying, "The banana zone slipped on a banana skin and took some nasty bruising, but it's far from over." In a recent post on X, Powell concluded by saying, "Eventual Fed cuts will usher in a weaker dollar period, which helps build macro summer and fall. Right now, we are in the maximum fear zone. Hold on tight and have a plan that suits your risk tolerance and time horizon. Zoom out and relax, this too shall pass. Remember, no leverage, no FOMO. Stick to your top 3 to 5 assets as your main holdings, use self-custody or multi-sig with good wallet hygiene, and only trade a small Deegan bag of less than 10%. HODL over a longer time horizon, ignore the noise, and buy the dip if you can." Do you believe the banana zone is still in play? Or are we on the brink of a global recession that could lead to even sharper price declines? Please share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.